Hey everybody, this is Brant with a market update for the week ending July 12, 2019. Got to tell you, I thought this was going to be one of the dullest weeks I've seen, kind of like we're moving into the summer doldrums. The S&P made a couple new highs this week over here and Friday over here. So let me pull up a SPY 5-minute on the week. Okay, so here is that Friday payrolls. And here we are opening Monday, Tuesday. Tuesday, I wrote to my members, I said, look, the market might as well be closed Monday and Tuesday. It hasn't done anything. And that's understandable because Jerome Powell was going to testify before Congress on Wednesday and Thursday. And we saw absolute, just monstrous volatility smashing to get the market off these lows. And here we go through the rest of the week. Again, really dull. Friday actually was surprisingly strong. So the S&P closed above the 3,000 level where you can see it had some resistance and closed at a new record high in the week, or new record high, period. I really don't care about record highs and all this stuff you see on CNBC. It's how did the market act. So this whole week, there was just nothing going on. And like I said, there's a lot of uncertainty. It's understandable. It's really kind of been like this since about the third week of June. But Friday was really strong. And, the S&P was up 0.5%. That's not the biggest gain in the world. And like I said, I don't care about the record high or closing above 3,000. It was the participation. So small caps had been really weak all week, not participating. And they were really strong on Friday. Really, every S&P cyclical sector was up. The only thing that was kind of holding them back, and really the market could have put in a lot more gains, was the healthcare sector sold off almost 2%. It was probably the strongest day that I've seen probably since the third week of June. So, the bulls have control of this market. You have to give any consolidations the benefit of the doubt, the right of way to bulls. So there's that little consolidation, and I put together a little measured move target, roughly 30.22 in that area. So one thing I do want to mention, volume has been running really light for the NYSE. It's been running about 20% below the 50-day average. And for the SPY, if we look in a little closer here, this was Friday. So this was actually the lowest volume of the week. That was kind of the one thing that stood out as like a dent in the day's strength. As far as on the downside, this would be kind of the stop here. And that's really right there about 29.73, somewhere in that area. And from a much bigger picture perspective, this is kind of what I'm still looking at, this broadening top. And I got to pull it down here. The trend line's going up off the chart. So that top really, are the upper trend line of that broadening pattern, sits around 30.30. And because the trend line is slanting up, if it took longer to get there, it could be slightly higher, but not too much higher. So does that mean the market has to reverse there? No, it doesn't. But this is the area that I see the best risk reward for entering short positions, like new short positions. I closed out my last one back here in May. So I've been wanting to get as close to this trend line as possible and then just wait on the market signal and see how it develops from there. Let me touch on TLT and gold before we get to the rest of the week. So here's a daily chart of TLT. And if you're a member of mine, you know I've loved bonds, treasuries, the last 6 months or so. And TLT had a really, really strong bull flag, about 2.5 months there. The stronger these patterns are, the stronger these bases are consolidations, the more gain they can support. And this actually hit, if you take it from this perspective, a first leg up, a big consolidation, and a second leg up, guess what? This would be the measured move, and TLT more or less hit it. I'm going to take a closer look here at this area with a 60-minute chart. So this was a constructive triangle, a symmetrical triangle, but the breakout from it just was not very convincing. So I've kind of just stayed on the sidelines here. I didn't get long, although I wanted to get long in TLT. Last time we got long was right here and rode it up. Over here we had another breakout attempt. So Monday morning of this week, one of the things I posted right away was I don't like how this happened. And then we're looking at the 3C charts. And here is that breakout attempt. No confirmation, and so Monday I said, look, I think we could go from basically a failed breakout and then a fast reversal, and the 3C charts basically confirmed that. So they did not confirm that breakout attempt, and you can see what happened the rest of the week. We did have a little positive divergence I put out on Monday morning. I know a few of you traded it. You can see it here. Let me just back this up a little bit. So as prices are coming down, we got a little positive divergence here. This is where I said, I'd put a stop about 129.75, and I had a couple people trade it and did well by the afternoon. But we did see some larger volume, and 3C reflects that here on the downside. So let's see if it holds 129.75. That area, 129.71, I drew this trend line in months ago. So if we look back, you can see it comes from here. I think that there's a really good chance that we're going to at least come down to 128 before we see any kind of consolidation attempt here. So I really like TLT. I like treasuries. I should be more specific about that. We'll see how it does when it comes down, but I don't want to buy it here yet. I do think it has more to go. Here's GLD for gold. Again, another really awesome looking chart. Great consolidations. Kind of like TLT, a really big bullish consolidation here. We got involved right here the day before it broke out, bought it long, and it has done really great since. This is very constructive for gold. I like that a lot. I am a little cautious in the near term. Let me go back to a 60-minute chart of this consolidation. So it's tried to break out a couple times. Getting a little bit closer here. Kind of like TLT, so it's tried to break out a few times here and really has not shown, like here when it tried, did not have great 3C confirmation. Actually, the 3C confirmation wasn't real strong in here. It did pick up here and then just didn't confirm after that, and it's come back down. So I don't think it's quite in the same danger of a failed breakout, but I would prefer if it came down in this consolidation, did a little bit more work, and if I pull this out, you can see the trend lines. So, you know, this could consolidate for another week, maybe two, something like that. I would rather see that. I do like gold better than TLT at this point. Silver looks really good too. Here are my basic trend lines for silver. Gold has been acting much better, but you can see it broke out of this downtrend and kind of started something like a little bull flag here. The thing I don't like about it, if we kind of zoom in a little closer on a 60-minute chart, there's the kind of bull flag. But really, let me take off the trend lines. You'll see that pattern is actually widening out. Here, it's widening out. So that's due to some false breakouts. Maybe it keeps going, but personally, with gold looking the way it does, either have some real tight stops or wait for it to consolidate a little bit more. But I think silver could do some real catching up to gold. So two final thoughts. One, over the last week on Twitter and various financial sites, traders, investors are absolutely outraged. According to President Trump, we have the strongest U.S. economy ever, the lowest unemployment rate, and we have stock markets at record highs. So what's the big deal? Why is the Fed cutting rates? This is why I really put up last weekend's video. If we go back, and if you haven't seen the actual video, just check out last weekend's video, the last one I did. This is the S&P 500 from 2007. These are the record highs, May and October, and the market came down from here and went into the financial crisis. The point I was trying to make is how things develop. You know, curves invert, the last rate hike from the Fed, the pause, and then the first rate cut. So if we zoom in here to 2007, the first rate cut was actually the discount rate, and the S&P went to make a new record high here in October. There was a 50 basis point cut before it did that. So the point is, the Fed doesn't typically cut rates when the market is already selling off and you're into a recession. They do it before. That was the record high right there. In the at the 2000 top, the Dow was only 6% off its record high before the first rate cut. The fact is, that generally happens when the market is near record highs anyway, and this is what happened after they kept cutting rates as the market went down, cutting rates. So this was the whole point of last weekend's video, that the market is excited about a rate cut. Should it be? And I want to wrap this up with this bigger picture, broadening formation, broadening top formation. So yes, the S&P and the Dow and the NASDAQ all made record highs, and then you have small caps that are 10% off this last record high in 2018. So why did I mention it? Again, I don't care about record high. That's a chyron on CNBC that gets people excited. It doesn't mean anything to me if the strength in the market is not there. I'm not looking at where the market is, I'm looking where the market will be going. So I want to show you two little charts real quick. Here's that broadening top and the S&P 500 daily chart. So when it made this high over here in January, how many sectors of the 11 S&P sectors made a new high and participated with it? 8 of 11 sectors, all the averages. The NYSE, the S&P, the Dow, the NASDAQ. Only one defensive sector out of the 3 made a new high. So the ones that didn't were the defensive sectors, and that's what you expect to see. Over here at the September high, there was only 5 sectors, and NYSE did not confirm. That's the biggest market in the world. At that point, of those 5 sectors, 2 of them were defensive. And at this record high now, only 5 of 11 S&P sectors have participated, making a higher high over here. And of those 5, 3 of them are defensive. In addition, NYSE is not participating. Russell 2000 small caps not participating. They're 10% off their high. And transports. So hopefully, to put this in some perspective, here's the S&P, that same chart I showed you from 2000 record high here. So the first higher high over here, 10 of 11 sectors were participating, making higher highs with the S&P. Over here at the May 2007 new record high, all 11 of 11 S&P sectors participated, all 11. And then by this October, and also all of the averages, NYSE, Dow, NASDAQ, small caps, all participated. This is the final high, the record high before the market turned down and went into the financial crisis. 6 S&P sectors participated. Russell 2000 and transports did not, but they were not off nearly as much as they are now. And the main sector really that didn't participate here, that really threw up a flag, was financials. Financials are not participating right now. So the point is, you go from 10, 11 sectors participating to this record high, only 6, and 2 of the main averages, the Russell 2000 transports, not participating, and then you look at where we are now. 8 sectors, 5 sectors, only 5 sectors, with NYSE, Russell, transports not participating. 3 of the 5 are defensive. This isn't my opinion, this is fact. So chew that over, and I'm going to wrap it up here. I hope everybody has a fantastic week, and we will be kicking off earnings season next week. That will start with the financials. Have a great weekend, everybody.